Hi, thanks so much for tuning in to BQ Prime. My name is Alex Matthew, and you're watching the Mutual Fund Show. This is the show that helps you make the right investment decisions. And often in this space, and of course across the industry, we speak about equity. But today, we're going to be focusing on fixed income because, boy, is this a good time to be considering your fixed income investments. Joining me to talk about how you should allocate and what strategy you should employ is Raghav Iyengar of Axis Mutual Fund, as well as Mrin Agarwal of Finsafe India. Thank you to the both of you for taking the time. Now, I want to start with you, Raghav, just to lay the context of where we stand right now. Just before we launched this conversation, you were saying that it's much easier to tell people about fixed income right now because it's incredibly lucrative. Why is that?
I think what has happened, Alex, in the last 18, 24 months, and I think if you go back in time, I think we had, the COVID crisis, which now seems to be like something that happened in the previous century, right? We've sort of so quickly overcome that and we're back to normal. But thanks to COVID, I think one big response which happened overall in the financial system was reserve banks, or rather central banks, pumped in a lot of liquidity into the system. That led to a bit of a fall in interest rates, which is very good for businesses, very good for small business owners, people paying loans, etc., etc. But that led to interest rates really coming down. In many points of time, it was much lower than the rate of inflation. Over the last, especially the last 18 months, I think most governments and central banks have realized that inflation is now a seriously worrying issue. And one way to fight inflation, Alex, is to obviously raise interest rates. So, like everywhere else in the world, our Reserve Bank has also raised interest rates substantially over the last, especially over the last 12, 13 months. Right? And I think you've seen, so now what we call real rates, which is essentially the rate of interest minus your approximate inflation rate, is actually positive today. So like we were talking, today, even a basic fund like a liquid fund today can give you a YTM of close to 7%. I mean, just to give you the year back scenario was possibly less than 5. So you can see it's just in a year, it's gone up 2%. The challenge for us in the industry, and largely, I think that's where people like Mrin will really help us, is that when interest rates go up, prices come down. So obviously, there's a what we call a negative mark to market in that. So obviously, when people look at their fixed income instruments, they don't see the rates going up; they actually see the prices coming down, because that happens first. But anyone who's putting money now is actually getting in at a much better portfolio yield than what he was getting maybe a year and a half back, and that's the exciting opportunity today, actually.
Yeah, the ability to lock in. You're saying 7%, but then I see a lot of funds that are over 5 years going up to 8, 9 years
yes,
that
absolutely.
give you 7.5+%.
Yes, absolutely.
And Mrin, that's where you come in, right? When you're planning a fixed income portfolio, often we talk about tactical allocations, but of course, one must take a longer term approach to building both equity and fixed income. So how does one look at the current context? And I think Raghav's laid this out very well when it comes to constructing a fixed income portfolio right now.
Yeah, so I think we're towards the peak of the interest rate cycle. And I do see a lot of investors still waiting for rate hikes. And, while we might have one or two more rate hikes, I think it's really difficult to just keep waiting for that right number. And it's a good time to make an entry because you do have various investment available on the debt side. You have actively managed funds, you have passively managed funds, and you are also getting very good yields at this point in time. So I think, the first thing is, of course, whenever you're constructing any portfolio, it's about what is your goal, which means what is your holding period. And secondly, what is the sort of risk that you're willing to take? And then you have a whole variety of options that are actually available today in the fixed income space.
Would you like to break that down for us before we toss it back to Raghav to talk about the two key approaches that you already pointed out? One is the passive approach and one is the active approach. And I think a lot of proponents have argued in favor or against the other. But some people have suggested, and I think that is something that can be considered, is a blend of the two. So why don't you take us through the options that an investor currently has?
Yes, I also agree that it should be a blend of both for various reasons. So, on actively managed debt funds have always been there, where you have a fund manager who's taking calls based on the interest rate scenario and taking calls based on credit risk in various companies. and constructing a portfolio. Now you have passively managed debt funds. So what this means is that, like in the case of equities, where the fund manager would mirror a particular index, here too a fund manager would mirror an index, but this would be a debt index. There are different types of passive debt funds that are available. So, for example, you have the most popular one, which is target maturity funds that are there. You also have gilt and liquid passive debt funds also available. Now, what happens in the target maturity fund is that there is a target date. So, while the scheme is open ended and you can exit the scheme whenever you want to, of course, at the current valuation, uh, but there is a target date on which the scheme is going to end. And by investing into a target maturity fund, your predictability of returns is much higher, because because it's a hold to maturity strategy where the fund manager buys the bonds and holds them to maturity. So you're fairly clear about the sort of returns you're going to generate out of this investment. So these are the basic two things that are there. The advantages of the passive fund is, of course, low cost. They're fairly liquid. You can still exit in between. But I think when you are actually constructing your portfolio, it helps to be very clear about what is your holding period. And if you're absolutely clear about it, you don't want to take any risk. You find it difficult to figure out what else fund to get into, then passive debt funds are the funds for you. But do remember that in active funds, fund managers can take some calls which can help improve the performance of the portfolio as well. So I would still go with a combination of active and passive debt funds.
Interesting. I want to toss it back to Raghav now, because I'm very curious to find out what he has to say and how he is communicating these points that Mrin has just explained about the benefits of both active and passive, because you have both options available, Raghav.
Yes, that's true. So passives are a very recent addition, Alex. I mean, in the sense that they didn't exist in a meaningful manner till maybe just about 12, 14 months back, right? And so we've seen in the last 6, 8 months a lot of money moving in the industry to passives. Like Mrin mentioned, I think the biggest advantage in a passive fund is you have predictability of portfolio, because you're essentially buying the index, so you can't buy anything else apart from that, and you have a predictability on your end date. These instruments were earlier called fixed maturity funds, if you remember, not too long ago. But FMPs had one big disadvantage, is that they were essentially illiquid. I mean, you can trade it in the stock exchange, but there's hardly any liquidity there. So if I needed to get out of an FMP in the middle of my investment journey for whatever reason, it's very difficult to do. So the advantage of say actively manages, it's a very, very old asset class. Like, for example, our biggest actively managed fund is Axis Short-Term Bond Fund. It's got like a 8-year plus investment history. So you can actually see what the fund manager has done at various points of time, and draw your conclusions from that, right? But yes, like it is an open-ended fund. So if you are not very clear as to when you're going to get out of that fund, you're not very sure, but you're just doing it from an asset allocation perspective, which is to my mind a very, very important component of your portfolio. If you're going to say, I'm going to have say 30% in debt, but you don't know when you need that debt fund investment, I think it's better to go for an actively managed fund, because the big disadvantage in passives is that it gets over. So you are exposing yourself to the biggest risk, which is reinvestment risk. Today, let's say we have an Axis SDL fund. As of yesterday evening, on the website, my YTM was close to 760. Right, but I don't know in 2027 what's going to be the portfolio yield or what's going to be the market at that point of time. Whereas a actively managed fund manager will do certain things to make sure that your portfolio is being optimized. So I think, like Mrin exactly said, I think it's an and strategy. You can't have an or strategy. You have to have both parts in your portfolio, and that's really very individual. So if you have a need in the next 3-5 years, and you can time that and you can marry that to a target maturity fund, that's fantastic. But if you don't have something, you're just investing from an asset allocation perspective, maybe better to stay with open-ended, actively managed funds.
Now, Raghav, there aren't many people that I think that are watching this show that are as tactical in their approach to fixed income investments as they are in equity. But you can, in fact, have a very tactical approach. And the reason I say this is that we're close to the peak of the interest rate cycle. And so theoretically, if you deploy in debt funds right now, you could potentially have capital gains over the course of the next 3 years when that interest rate cycle turns. How do you best take advantage of a turn in the interest rate cycle? Would it be through a passive approach, where I think people generally, like Mrin pointed out, have a hold to maturity approach and they're looking for more predictability, or is it through an active approach?
I think you can do it in both actually, Alex. So because obviously, if you have a view that you're going to make a lot of money on capital gains and you feel that interest rates have peaked out, then you'll obviously try and get into the longest duration fund possible, right? And there are funds like, we have approval to launch a 2032 passively managed fund, GSEC fund. That's like practically 9 years or 10 years of maturity, right? So you can do it like that. The other way is, of course, you play a normal open-ended fund, and you again have a track record of what the fund manager has done at various peaks and troughs of the interest rate cycle. My belief is unfortunately a bit different. I think fixed income is also an equity type asset class. You have to fill it, shut it, and forget it. For the simple reason is that I think the tax laws in mutual funds are very, very conducive to creating wealth through fixed income. I mean, you don't pay any income tax till you actually take out the money. When you do pay tax, it's actually on a higher principal amount because you get the benefit of what we call indexation. And of course, the longer you keep it, the more number of indexations you get. So I've had investors who kept money for 8, 10, 11, 12 years. And, fortunately, I've made good money on a CAGR basis, pretty much similar to what some of our balance funds have made. And at the same time, not really paid too much tax on it. So I think I think this is misnomer in people's mind that fixed income is for 3 months, 6 months, 1 year. Yes, it is for those things, but you can actually keep it for very long duration. But yeah, coming back to your point, yes, I mean, if you are a believer in peak interest rates, which is a very debatable topic today, news channels are full of it. But yeah, I agree with you. We are somewhere close to the top. I don't know whether there's another 25 or 50 coming. It will be led by what is happening internationally. But I think in India, frankly, I think we've done a much better job in managing inflation than many other parts of the world. And I think possibly because of that, maybe the rate cycle is pretty much close to the top. So yeah, in that sense, yes, you should put money into a long duration fund and ride the capital gains all the way down.
Just to follow up to that, Mrin, before I come to you, a lot has been said about the yield curve right now and the fact that, Raghav, between 3 year and all the way up to 9, 10 years, there's not too much of a difference in the yields. And so why would you want to lock in for that much, for that long, if you get the same yield in a 3 year paper or a 4 year paper, and you can play that through a dynamic bond fund? Is that a strong argument to make?
Well,
Raghav, this is for Raghav. I'll come back to you, Mrin, on that.
I think Mrin is brilliant for these things, but yeah, because she actually talks to live investors. I talk to you and to her actually more of the time. But yeah, you're right. I think the fact is, you can, like you said, you can do both. You can do the 2032. The reason as why somebody should take a longer duration asset is not obviously capital gains is a bit of a pitch in the dark because you're trying to guess estimate the interest rate cycle, right? Which frankly is very difficult to do. It's like predicting the Sensex. But I would go for a long duration fund more from a longer term need perspective that, hey, I can get maybe for a 10-year asset today, if I get close to 8%, I think that's a great yield to lock in money. And I will keep that money for 10 years because I don't know, I'm reducing my reinvestment risk by that much.
Fair point. Mrin, you were going to make a point, and I also wanted to ask you, when it comes to this passive approach, a lot has been said in the recent past about laddering, and this is becoming better as an option because you have more options along that 3, 5, 7, 10 year period, right? Mrin, this one's for you.
Yeah, sorry, I think I just lost you for a minute. Yes, I mean, I would also agree with Raghav that I would try to lock in into long-term interest into long duration debt funds right now because you're getting good interest rates, you're getting good yields, and there is a huge reinvestment risk. So let's say that you go in for a 3 year target maturity fund, you do face a reinvestment risk at the end of 3 years, and we don't know what interest rates are going to look like. Typically, when I look in the past, also, when I looked at the highest tax-free bonds that came way back, I think in 2010, the return was 8% tax-free. And with some of these passive funds, you're actually getting not 8%, but maybe slightly lower, but still very good rates on a post-tax basis. So I think it really makes sense to lock in for as long as you can, of course, based on your goal. Now, laddering is an approach that has been used, and the advantage of laddering is that you make investments which are maturing at different points in time. So that allows you to have maturities every year, which then you can redeploy. And that somewhere does sometimes take care of the reinvestment risk and the interest rate risk. But honestly, Alex, I believe that when you're constructing a portfolio, it really has to be based on what is your holding period, which is based on your financial goals, and that in itself will help you create a laddering portfolio.
Yeah, when we're constructing that fixed income portfolio, I think the thesis when people are constructing a portfolio is that the alpha generation is from the equity side and the rest is capital conservation, right? And you're getting that predictability when you're looking at your fixed income portfolio. From that perspective, the mix that you've talked about and the focus on duration and how to structure your investments in that sense makes a lot of sense. But I just want to understand from the perspective of sweeping from debt into equity. Do you have a specific portion of your fixed income portfolio, Mrin, that you use to sweep into equity when the opportunity arises? And one great example of that is the early part of 2020 when equity markets crashed and a lot of people deployed into equity. Do you have a more flexible portion of your fixed income portfolio?
Yeah, you can always have that. I mean, you can always keep some amount of money in ultra short duration funds or low duration funds for this particular purpose. But to be honest, I also believe that there is ability to create alpha even in debt portfolios by taking some tactical calls. And while debt investments are done for conservation of capital, I don't think that one should just go in for the safest instrument that's available. I mean, certainly there are opportunities within the debt space as well that can be looked at. And again, I'm not talking about lower credit risk options. I'm talking about good credit risk options itself that can be considered. And I would say actually, for example, maybe like one of the tactical allocations, since you were talking about it, is to look at investing into gilt funds at higher interest rate or at higher yields.
Fair point. From the industry perspective, Raghav, again, this is an interesting point because one would think that with the interest rate or interest rates in the system close to their peak, there are people that would shift away from mutual funds into fixed deposits or traditional investments because of the optical nature of those yields, right? And though you pointed out very correctly, the long-term capital gains tax on fixed income mutual funds is highly attractive with that indexation benefits. Is that a challenge that you're facing? And how do you communicate the benefits of holding on to fixed income investments for the long term?
That's the proverbial pot of gold, right, Alex? Because bank fixed deposits are many times the size of retail debt assets, if I may use that term. And yeah, but it is, and I have seen in my career that whenever interest rates start trending close to 8% on traditional instruments, obviously there is a flight of money that goes out into those instruments, because obviously I think what an investor is looking for in fixed income is predictability, and traditional instruments offer the best predictability today, right? And so I think there's a bit of a swing, and we saw swing out about 2 years back when, thanks to COVID and thanks to liquidity, rates came down dramatically and they were much lower than what they are today. So that little bit of swing is going back. But as far as the second part is concerned, I think the communication is now, we are a 25-year, I think bond funds have been in existence now for 24, 25 years. So we have seen the kind of value that they've delivered over a 20-year period. So like we talk about equity funds for 20 years and it's made so much wealth for you, you do have a number in bond funds. And that number is quite attractive. Like Mrin pointed out, it is fairly similar to what you would have made in a tax-free bond had you invested 10, 15 years back in the highest tax-free bond at that time. And the other thing I think people are trying to now understand very clearly is that this is a great way to defer your tax, because you don't need to pay tax on your mutual fund investments debt side as long as you don't take it out. Plus you have the flexibility, right? I mean, if you have a lakh of rupees and you need only 5,000, you take out the 5,000, you pay the money on the 5,000. So these are some 3-4 things that we're trying to say, which is a bit distinct. But yeah, today, yes, there is an outflow of money, and that's fine. I mean, that's okay, because as long as money is in the financial system, it's okay. I think someday it will chase the best quality service provider for it. Yes.
Fantastic. A last point with regard to investing into target maturity funds. Mrin, this one's for you. What should you bear in mind? Because I think a lot of people will go through this over the course of the next 4-5 years. They'll see a significant pop in their holdings because of the mark to market, as Raghav has pointed out, but they might also see the downside. Is it then really, really important to strategize and to hold to maturity? Is that the approach to have?
Yes, ideally, I think if you're getting into a target maturity fund, it should be a clear hold to maturity strategy. The points to keep in mind is that you can exit in the interim, but it would
Okay.
you won't see the NAV volatility. The second thing is also that sometimes the secondary market liquidity in specific funds could be low. So maybe there could be lack of trades and stuff like that. So that's the other aspect that one has to keep in mind. And while right now we are seeing this rising interest rate scenario, it could, if things were the other way around, then you may not want to be in a TMF, right? So I think right now it's good to look at it, but be very clear about your holding period and be clear that you can hold it. Like, think of it like how you did a tax-free bond is what I would say. And as long as you're clear about your holding period and willing to hold on, I think it works for you. But if you are looking at if you're not sure of your holding period, looking at something which is more liquid, then I think you should certainly look at the actively managed debt funds.
Fantastic. So the closing points, I think, by both my guests today make a lot of sense when it comes to constructing your fixed income portfolio. Pay attention to the goals that you have, the holding period that you have, and look at a balance between the two approaches that are currently available. Mrin as well as Raghav, thank you so much for taking the time. Pleasure speaking with you.
Thank you so much.
Thank you.
Thanks, guys.